Use of alpha in mutual funds. Did you just hear a fund manager or a fundamental investor talking about alpha? You must be wondering as to how this concept is related to investments in mutual funds. Alpha is the excess return a fund produces in relation to its peers and its benchmark. It gauges an investment's performance given the price risk or volatility relative to comparable investment. If alpha is greater than 0, the fund's returns has outperformed its benchmark index, and if alpha is less than 0, the fund's returns has underperformed the benchmark. When the alpha is 0, its return matches the benchmark. Alpha is a historical number. It's useful to track a stock's alpha over time to see how it did, but it cannot tell you how it will do tomorrow. Let's take an example to take a closer look at alpha and how it is used to assess the funds before investing in them. Anupam Tiwari manages a mutual fund scheme named Access Small Cap Fund that invests majorly in small cap stocks. And Pankaj Tibrewal manages a mutual fund scheme named Kotak Small Cap Fund, which also invests in small cap stocks. Kate is an individual investor who is considering investing in either of the funds, which provides her with attractive returns. She uses a mutual fund screening tool to look at the fund's alpha, which is at 12.57% for Access Small Cap Fund and at 10.82% for Kotak Small Cap Fund. That means both funds have outperformed its benchmark, the S&P BSE TRI index, by 12.57% and 10.82% respectively. But it can also be concluded that in relation to its peer Kotak Small Cap Fund, Access Small Cap Fund has performed better with an alpha of 12.57%, which gives a 1.75% extra return as compared to Kotak Small Cap. Other than this, the alpha figure also tells Kate that for the amount of risk both fund managers take, their performance is good enough. Investors must be careful to compare funds that are in the same asset class. Comparing the alpha of an emerging market fund with an alpha of a municipal bond fund wouldn't make sense, as these funds represent completely different levels of risk. Now we will talk about how you as an investor can benefit from the use of alpha. Always seek a positive value of alpha, as it tells you that the portfolio's return exceeded the benchmark index performance. Staying away from a negative alpha number that reflects an investment that is underperforming as compared to the market average is a prudent decision that will help you to get a better return on investment in the long term and preserve your investment average. Use alpha as a rear view mirror, which makes us cautious of the performance of the fund manager and tells you if you are earning enough for the risk that you are taking. Alpha allows you to calculate your risk-adjusted returns, and that enables you to compare funds across the equity categories. You don't compare apples and oranges. Instead, you have a proper basis to compare fund performance and fund manager performance thanks to alpha. Hence, alpha provides you with all the help you need in assessing your mutual fund investments. It solves your dilemma when you are just baffled seeing the 1,000 schemes out there in the market and helps you choose the best scheme giving attractive returns. Prudence is investing smartly. Stay safe and keep investing.